So last month in our lending update, we talked about a seller strategy where they could apply 2% of the purchase price towards the rate for the buyer to attract the lowest rate in the market. But this month in our lending update, we talk about a 2-1 buy down, which is a product that's been on the shelf for Fannie Mae for quite some time, and we're seeing it re-enter the market. It's a graduated payment type mortgage, and here to talk about today is Daniel Halverson.
Yeah, and we actually covered a couple of different products in our most recent lending update. The first being adjustable rate mortgages.
hmm
And essentially, the way that that works is the interest rate on the loan is fixed for a set period of time, generally 5 to 7 years. And after that point, the interest rate can adjust either every 6 months or every year. The interest rate's attached to an index and it will adjust according to if that interest rate goes up or down.
We're starting to see a couple more of those come back to the market than what we see during 2020, 2021.
Absolutely. There wasn't a great need for that in an environment where fixed rates were so low. But as interest rates go up, that's a product that we see come on the market a little bit more. And ultimately, the buyer is compensated for the additional risk of the adjustable rate with a lower interest rate during the fixed rate period. And then the other thing that we talked about, which you alluded to, is the 2-1 temporary rate buydown. And just to explain that in very basic terms, essentially, the 2-1 buy down for the first year of the buyer's mortgage, the buyer receives an interest rate 2% lower than their note rate.
So if the note rate's like 6%, they're going to get 4% to start.
That is correct. Yep.
Okay.
In that same example, at the end of 12 months, the interest rate then increases to 1% below the note rate. So that 4% would increase to 5%. And then at the end of year two, the interest rate would go up to 6%, the original note rate, where it would stay for the entire remaining 28 years of the loan.
So very important. This is not an ARM. This is a graduated payment scale mortgage called a 2-1 buy down.
Correct. There's no risk variable there because the buyer knows what their interest rate will be. It will be a fixed rate. They just receive essentially a subsidized interest rate for the first 2 years. And it really is subsidized because a third party is prepaying the interest differential for that first 2 years at the time of closing.
And
So,
that third party in this case might be the seller.
correct. So,
And so why would the seller want to pay this?
well, I think it goes back to the seller buy down. If you've got a market where sellers' homes not moving maybe as quickly as they'd like, and instead of a significant price reduction, the seller may be able to offer a concession to essentially reduce the interest rate by an amount that a price reduction wouldn't be able to achieve without a significant price reduction, rather. And the buyer has increased affordability for the first 2 years of that loan.
So let's just paint a picture. Seller has a home for $750,000. It's been sitting for 30 days. It's not moving. The typical price reduction would start at 30,000 on that property. In this case, the seller would pay 2%, which is $15,000, and the buyer would get a rate at 4%, much lower than the market rate, and the seller would save $15,000 from the previous suggested price reduction. Sounds like a win for the seller.
Absolutely. And really, the price reduction would have to be considerably more than that to achieve that same payment
Mm,
you're getting at a
good point.
2% lower interest rate. But I think the last thing I'll say is to provide some context. This isn't a product that the majority of home buyers are going to take advantage of. This is something that it's just another tool in the tool belt, and it's something that a very select group of people may benefit from. So just a few examples. One scenario where an adjustable rate or a temporary buy down might make sense would be if a buyer doesn't anticipate being in a home for very long. So if they plan to be in the home 5 years or less, chances are this could be something that would be worth consideration. Number two would be maybe somebody that's relatively earlier in their career that anticipates significant increases in income.
Right. So it's
So,
someone that's gonna is he might be commission starting, they have variable income there, or someone that is climbing that ladder of success and they're starting.
correct, or
This makes sense.
a doctor in residency, that may be
Great
another one
point.
that's a great example. And then the third is really just somebody that maybe has a little bit greater of a risk appetite than the typical home buyer.
Yeah, and talk to that a little bit. When you say risk appetite, it's not risk of the mortgage changing at all. It's more or less risk of, hey, the market's gonna move down and I'm willing to risk that.
I would say in the case of the 2-1 buy down, absolutely. I think it's betting on interest rates being lower than where they're at right now, which is at highest level since 2009. With an adjustable rate mortgage, obviously there's a little bit more of a risk component, but I think that the same people that would take on a product like that right now would probably be in that same line of thinking that interest rates are probably going to be in a position where they could refinance before their fixed rate period expires, to kind of mitigate that risk and ultimately end up with a lower interest rate on their mortgage.
So to sum this up, if I'm a listing agent and I'm sitting in front of a seller right now and I'm not wanting to talk price reduction right away, 'cause I'm not comfortable with it, or maybe we're not ready for it yet. This seems like a great conversation piece to insert right before then. And how do I describe that to them?
Absolutely. I think that you have to help the seller illustrate that it's more money in their pocket. Ultimately, they would have to reduce the price by a considerable amount to attract that same buyer. And it really is just an education piece for buyer and seller. And it's really important that that's a conversation that the buyer gets to have before they go shopping for a home.
Hmm.
If you know that that's something that you want to pursue as you go into it, that buyer may be more likely to present a stronger offer, knowing that they have the ability to maybe get a concession from the seller in some amount that will significantly increase their affordability.
Great. Well, hey, thank you for explaining that. For further questions, please reach out to the team down at Bank of England here in Jacksonville, 904-992-1000.
Got one more shot, I'm gonna make it. One more chance, I'm gonna take it. I meant it when I said it, now it's time for me to do it. I got one life to live, so I put my all into it, yeah.